Hey Samson, this is Priya from Samaya. Today we are going to discuss about SA 320, materiality in planning and performing the audit. As usual, first we'll dive into the objectives of the auditor with regards to SA 320. The objective of the auditor is to apply the concept of materiality appropriately in planning and performing the audit. The auditor has to first determine the materiality and then apply it in the audit. What is performance materiality? Performance materiality is something that is amount which is lesser than materiality amount. Why he's choosing performance materiality even when there was a materiality amount that was already determined? Because when we apply some materiality concept, few amounts do not come into the ambit of the materiality because of being lower or smaller in number. But all such misstatements which are not material as per the materiality concept but were put together, were in aggregate, would be exceeding the materiality. So in order to uh, lesser that situations, in order to make that risk lower, auditor performs or determines the performance materiality. It's an amount which is set by auditor less than the materiality for financial statements as a whole, to reduce appropriately the low level of probability that aggregate of uncorrected or undetected misstatement exceed materiality for that financial statements as a whole. You see, materiality can be for financial statement as a whole, or for class of transactions, or a particular class of transaction, or a particular account balance, or a particular disclosure. But performance materiality was for a financial statement as a whole. And with that said, we'll dive into SA 320, what the auditor shall document. What does he do? He shall document. What is he doing? He's preparing the materiality and performance materiality. He has to document that only. Materiality for the financial statement as a whole. Materiality for a particular class of transactions, account balances, or disclosures. You see, materiality has to be for financial statement as a whole and for such particular class of transaction or account balance or disclosures. You can prepare the materiality amount for any of this kind, and performance materiality, financial statement as a whole, and any revision that was done to the materiality. And determining materiality. While determining materiality, what are all the considerations that the auditor has to consider? The elements of the financial statements, all the assets, liabilities, equity, revenue, and expenditure. Materiality is like a percentage on some amount, like for the stock, or what's the materiality? A percentage on COGS, like 1%, 0.5% of the COGS that was sold. And for the debtors, for the bad debts, it could be like a 5% of the debtors. It's like that. Materiality would be determined like that. Whether there are any items on which attention of users, particular entities' financial statements tend to be focused on. You see, like litigations that were happened, even though the litigation amount, the expenses for with regards to the non-compliance or with regards to payment of lawyers, though the amount was uh, comparatively smaller with regards to other elements in the financial statement, they tend to signify, or they tend to track the attention of the users of the financial statements. So we have to also check the materiality, check all such items while determining the materiality and the nature of the entity. Whether it's a construction company or a real estate company, or it's a service-based entity, anything, you have to obtain the nature. You have to also consider the nature of the entity and its economic environment and its operating cycle or life cycle. And entity's ownership structure and way it is financed. Ownership structure is with regards to the associates or subsidiaries or investment companies or related party transactions, all this. And with regards to finance or the equity, the share capital that was invested, or the long-term loans that have been taken, also have to be taken into consideration. And the relative volatility of the benchmark. Benchmark is, as we have discussed for the bad debts, it's the debtors. Debtors is a such 5% of debtors is a benchmark. Like benchmark is with regards to the industry, usually in that entity that in which it is situated in that industry, there would be a common benchmarks for that, common ratios or percentages. When establishing the overall audit strategy, the auditor shall determine materiality for the financial statement as a whole. You see, this was asked in an MCQ also, but don't get mistaken with here and materiality. As materiality here is for the financial statement as a whole, and you also have to determine the materiality for a particular class of transaction. But with regards to while establishing overall audit strategy, that is when overall audit strategy was done at the planning stage of the audit, you don't get more into the financial statement, so that you determine the materiality for whole financial statement as a whole, not for that particular balance or particular account class of transactions. So make a note out of this. While establishing the overall audit strategy, materiality is only for the financial statement as a whole. While you do the audit in more detail, then you form materiality for that particular class of transactions or particular disclosures, etc. If one or more class of account disclosures for which misstatement of lesser amount than materiality for financial statement as a whole, auditor may determine materiality to be applied to those class accounts or disclosures. The auditor shall revise materiality for financial statement as a whole on becoming aware of information during the audit which caused the auditor to determine a different amount initially. That was they're saying that it is as like overall audit strategy and overall audit program or audit plan, how they were dynamic and they could change with the information that was get by the auditor. Likewise, even the materiality could also be revised. And if auditor concludes lower materiality for financial statement as a whole, the auditor shall determine whether necessary to revise performance materiality and whether nature, timing, or extent of further audit procedures appropriate. Now, he got some information which revised the materiality. Now, lower the materiality. When the materiality was lowered by the auditor, at that time he also have to check whether it's necessary to revise the performance materiality, because performance materiality is always lower to that of materiality. When that gap was not maintained adequate enough as to the previous materiality or the old materiality concept, it doesn't serve for the purpose, the material performance materiality. So he has to check whether he has to revise the performance materiality or not. And with that said, we have completed our essay 320 with